It took me 3 years before my portfolio actually yielded an overall profit.
Give me some good examples, some good stocks that you've invested in over time that you think have really performed.
I think investing...
But I lost a lot of money.
See the money you lost, that number is a course. The market gave you a course in crypto and it charged you
it did
an arm and a leg.
This is all not real.
You're getting about 3% annual when you take out stamp duty, taxes and property appreciation in the UK on a buy-to-let. Investing in crypto today is very different to 4 years ago or 8 years ago when there wasn't that much adoption. Now there's no excuse.
If I came to you now and I said, I've got 5k, I'm working 9 to 5, so I don't have loads of time, what kind of direction would you give me?
2 ways to invest in the stock market.
And we are back for another episode of the PBK podcast. Each and every week we bring you a special guest and we talk all things property investment and a little bit of life advice. Now today I'm joined by Coach Debs, aka founder of the Stock Pickers Academy. How you doing?
I'm good, my bro. Thanks for having me on.
Now, we very frequently talk about why it's best to invest in property, why you should buy houses, flats, commercial property, but you're here to give us a different viewpoint because your asset class that you generally invest in is quite different.
Yeah.
So talk to me. And bear in mind, we've spoken about this off camera.
Yeah, I know. Yeah.
I don't really know what's going on in the stocks world. So as a starting point, like stock, shares, crypto, like what is it that you focus on?
Well, you're in the group now, so like you'll start seeing more and more activity and learning bits and pieces. But if you go back in history, our ancestors bought land and built houses. So property is that asset class that just has the test of time, bricks and mortar, and it's something that most people can understand the concept of building something and living in it, or buying something and living in it. You need a roof over your head. Now with the stock market, it's a different game. It is the ownership of established businesses. Now most people are comfortable with the idea of maybe becoming an entrepreneur or starting a business, but for some reason aren't so comfortable with the idea of owning a piece of a business that's way more established than the business you want to start, or your friend's business that you might want to invest in.
I think for a lot of people, I think it's exactly that. It's the peace element. You know, like when you start a business or when you buy a house, you feel like, I've got it.
Yeah.
This is mine. Like the reason I got into property was the business I ran before. I felt like I didn't have control over the asset. And I think that's why a lot of people like it. But the control also means that you're ultimately responsible and have to do a lot more work.
Yeah.
And I guess that's why, depending on how you invest in stocks, that's why it can actually be an upside for the people that invest in the asset class.
But you know, people only care about control when it comes to the stock market. If you look at shopping, do people care too much about whether what they buy isn't what they wanted, spoils, doesn't last, is expensive, or even holidays? You go on a trip and you come back and it might not be the experience you wanted, right? So it's seen as, we look at that as spending rather than investing. Whereas I feel a lot of people look at investments like spending on something they don't understand. And education really is the central point to where people can make informed decisions of where their money goes.
But when I like spend money on, whether it's the supermarket, whether it's, what do I like at the moment? I've been enjoying cookie dough recently, like cookie dough. I'm a cookie dough connoisseur, various different food outlets. I order a cookie dough, but I'm buying on the basis that, yes, it could spoil. Yes, I could not finish it, or it could not be nice. But I'm buying it on the basis that I'm going to buy it, consume it, and that's my trade-off for my money versus the product. Whereas when we're investing, I'm investing on the basis of, okay, I'm going to park my money somewhere in the hope that it's worth more in the future to maybe then go and buy more cookie dough.
Okay, fair enough. I think with property, a lot of people right now have experienced buying a house, renovating the house, living in the house, paying the mortgage, and then 15 years later, 20 years later, they're looking at the value of the house, they're looking at the price they bought it, they're subtracting the stamp duty, the money they've spent renovating it, getting a new bathroom, because every 10 years, 15 years, people will probably do something, right? And you can't really run away from that unless you're just going to watch your house deteriorate in value. And you're also told that when you do renovations on the house, it increases value. But a lot of people are actually experiencing that their house value now compared to where they bought it and the money they've spent has yielded some return, but nothing near what they actually thought. Now we can say, okay, you didn't do your due diligence properly, you didn't buy in a place that could appreciate, but that's most people. Most people don't really buy property and really, really deep where it can appreciate.
People that bought like if you're talking about people that bought 15 years ago would have been, circa 2010.
Yeah.
Probably would have, because that's off the back of the 2008 financial crisis. So prices would have dropped and then they've come back up. People that maybe bought 17, 18 years ago would probably fit right into that category of that prices have gone up, but not as drastically as they would have. But they have still gone up. But I think the trade-off is that you're still also paying for something that you get to use. So when you invest in property in that instance, the trade-off is, like you said, everybody needs somewhere to live. So you get to live in the home and enjoy the home.
Yeah.
And if that asset increases in value at the same time, then there's that upside. Even for those who don't live in the home, you bought the property, you've rented it out, you've probably got a mortgage, you've got your set expenses, you've got your set income. The hope is that you make a margin on a monthly basis or an annualized basis, depending on how you look at it. And then over time, there's an appreciation. But I think like realistically, I was kind of like, just asking, for a lot of people who invest in property, this is what we do, this is what we know. And some people do really well in it, some people don't do as well. But, potentially diversifying for a lot of people for different types of asset classes. Like, what's some of, the upsides? Give me some good examples, some good stocks that you've invested in over time that you think have really performed.
Yeah, so I think investing within an ISA is first and foremost one of the most important things to do if you're in the UK. Because tax, you don't pay taxes on your investments in an ISA. And this becomes more important over time when you start having large amounts, or your investments have grown over time. Whereas if you do like a buy to let, you buy it, you rent it out and you hold it for 20 years and you decide to sell it, you're still going to pay taxes on the capital gains. I actually did some analysis that you're getting about 3% annual when you take out stamp duty, taxes, and property appreciation in the UK on a buy-to-let. Yes, someone's helping you to pay your mortgage, and I incorporated that as well in this calculation, and you get like about 4.5%.
Yeah, yield what on just the rental return to include?
No, this is like all in
combined. So the rental and
capital appreciation, how much of your mortgage has been paid off by your renters, how much, let's say you get like a 300k house and this is assuming a mortgage rate of about 4%. So the numbers actually are okay, but they're not as fantastic as people realize. And it's not buy stocks, don't buy property. It's, are you educated and informed enough to even to make that decision on where your money is going? Because if you are I've got people investing in property and stocks in the group, right? So they've got the education on both, and then they just decide where they allocate their capital at each point. And that's, for me, the most important thing.
So with investing in stocks, like, because again, it's not something that I'm super, aware of. Like, I think there's a big difference in people who do kind of long-term holds versus like day trading.
Yeah, get rich quick.
So what is there a preference? Do you do both? Do you only do one type of investment?
I come from a background of being a trader. I worked at Goldman Sachs, I worked at Barclays. I worked at a Jewish family office.
What age were you when you started at, where did you start first? Barclays or Goldman?
Goldman. Yeah.
Out of uni or
Yeah.
grad scheme or what was it?
Out of uni. So I did maths at University of Warwick.
Good uni, you know. Say that with a
it's
little
a
bit
nice,
more.
it's a
Yeah, a
nice
little bit
uni.
more bass. University
Yeah.
of, we got to speak into the mic and say, University of Warwick. Oh, we got the same laugh. Nah, this must be a little Nigerian weird laugh. That was very, very similar. I'm going to watch that back, but that seemed like we've just foreshadowed that. Okay, so University of Warwick.
Yeah, I did maths. I actually did a summer internship at Barclays.
Okay.
On the trading desk. And I really fell in love with it. I got offered a job at the end of it. Lehman Brothers went down. The job got taken away. Went back to final year. Uni did have a job. Started sending emails out. Eventually, I landed a role at Goldman, and I was 20 years old. I went through school a year early.
That's cold though. Goldman at 20s. That's a.
I think I didn't deep it. I deeped the element of landing a trading job
more than to wear a good suit. Yeah. Like in your head, you was like, I'm gonna get a bad suit.
No,
like,
I knew they're the best. So Goldman is like they're the Real Madrid or the
Barcelona.
They're the best investment bank in the world.
United right now. For the footballers, they're gonna look at you and say, so you was in the bin.
Yeah.
But okay, so that's because Goldman, even Barclays, for a lot of people, you know, the idea of being a trader at that age is like they're saying, you're the
to put things in perspective, white elites who went to top schools, Oxford, Cambridge, struggled to get trading jobs anywhere, yet alone at Goldman. So even in other circles, it's seen as like a top role to get because of how competitive it is to get a role there. Like even the summer internship, there's like 40,000 applicants and maybe 100.
I feel like I might have applied. I feel like I did apply. Like I know I applied at JP Morgan.
Yeah.
I was at Deloitte for a little while. I obviously applied there. But I think even Goldman, I looked at Goldman like, the application looked scary.
I can't even remember the application.
I don't even think it was the hardest. But I think just mentally I thought, that's tough.
Goldman was the only investment bank that didn't have the minimum T1 requirement. And the application form was just like, probably, I think the simplest.
Yeah.
But they really, really care about the interview, like how you interview matters. So I went through school a year early, landed a job at Goldman. But the point I'm really making is that's where I really learned how to look at risk. So they care about you understanding all the different asset classes. So that's the bit that kind of has transcended into what I do now. So if what happened last night, there was an attack by Israel on Iran. Oil prices jumped 8%. You need to know, how does that news affect oil? How does it affect stocks? How does it affect interest rates and future expectations of how interest rates can move? And how can it affect gold? And now you'd need to know, how does it affect Bitcoin? Right? Because it's part of the asset class. How does it affect emerging market countries in all those asset classes as well? How does it affect bonds? So from a very young age of like 18, 19, I started to develop that cross-asset mindset. So when I got to interviews, that was the thing that they were really impressed about, that anything could happen in the world, and I could explain to you, okay, oil goes up, stocks go down, bonds go up, gold goes up, and I could tell you why. So I always was able to have a view. Now, your asset class is how you express that view, the product knowledge. Do you actually put a trade on in the stock market? But I was working in a stocks division, so my knowledge was focused on stocks. But if you think interest rates are going to go down because of some news, what effect does that have on stocks? You still need to know the effect on interest rates. And I was trading interest rate derivatives as well to hedge my positions. So when we come back to the conversation on property, I am a return on investment investor. I don't care if it's flowers. I don't care if it's... I just want to know what can make me a return. How do I do that?
Relative to
what
the
does
risk.
that relative? So a lot of people don't look at comparison, right? Comparison is not the thief of joy when it comes to investing. It is all about comparing.
And I think this is a conversation we always try and have. It's like, listen, it's way more impressive. Like if you were to able to put stuff in numbers to make £10 from taking a 1% risk than making £20 from a 50% risk.
Exactly.
Because your relative, how many times you could repeat that process and get the same return is going to, over time, like the maths will diminish the likelihood of it reoccurring.
Yeah. Diminishing marginal returns. So I worked in a hedge fund where they build mathematical models to create bots that trade a market, complicated box. They call them black boxes. And that was the first time outside of the Goldman environment. That's the first time I saw emotions really completely taken out of the thought process. It was we're looking at Canadian stocks, Taiwanese stocks, Indian stocks, Japanese stocks, Australian stocks, European stocks. And then we're looking at futures, which is a product. And in futures, you can have orange juice futures, cotton futures, sugar futures, cocoa, oil, precious metals. And then you had currencies all around the world. Now, one of the biggest takeaways from these algos is that in the stock market, for example, they look at factors. So one factor could be price. Another factor could be volatility. Another factor could be how big or small the company is. Is it a penny stock, high risk, or is it a massive company like Apple or Tesla? So they've got all these factors, nearly like 30. And what they're doing is they're saying, at any one point in time, before making an investment decision, which of these 30 factors are the most important?
Cause see, like all of this stuff kind of like, I get it. Like from a like economics background, I get it. But then my practical head says, this is all not real. Like this is all just a big, like, it's not conspiracy theory. This is just be listed as saying that it's because it's all so wholly built on, I guess, consumer and market confidence that the right company that actually has the right books poorly analyzed can fold because the confidence in it can just go. And that's why it's like, realistically, because the powers that be that control, like, you know, the level of investment in a certain stock or currency or option or future, if the right company makes the wrong decision for whatever reason, and that's why I say it is very much
Tesla's
like,
a great example of that. The amount of times in the past 12 years I've seen Tesla drop by more than 60% is incredible, right? But investing is all about strategy more than it is about picking the right. You don't need to know who I am to know that Apple is a great company.
Yeah.
But if you buy Apple at the wrong price, one of two things could happen. You could lose money. Three things. You can make a bit of money. You could lose money. But also, when it comes to comparison, you can, if you buy a bad price over a 10-year period, you could have made 50%, right? So imagine 100K in Apple over a 10-year period and you've made 50K. You're probably thinking, I've made 50K. But then I'll say to you, do you know what the equivalent annual percentage gain is for that, right? So let's say it's 5% per year. It will take you 72 divided by 5, 1.45 or 14.5 years to actually double that, right? So somewhere halfway between, let's say 8 years to make 50% at 5%. So it's probably even less than that. So it's probably like 3 to 3. I'll know the calculation later, but maybe like 3.5% annualized. To make that 50% over a 10-year period. That's not great. Their bank's paying 4% now.
Yeah.
So with less risk, you could have achieved the same.
And I think that's why going back to like relative return on risk and, and it's like in the property space, for example, a lot of people that, say we're out here looking for investors, they're looking for, passive investors for their projects. When interest rates are at, 2%, like, but it's like market 2%, but relative zero, like you offering 8% was a great deal because bonds are at 3% sort of thing. Whereas now if bonds, you can 5.5% plus, you as Joe Blogs offering somebody 8%, now the relative risk is, would I rather invest in, a government bond backed by the billions, or whether risk has with a podcast, for an extra 3%. And that's where people really need to understand it's not always just about how you invest or what you invest, but it's what the offering is relative to the market.
Risk. Yes.
So with all of that in mind, what's your strategies? Because obviously we're talking about, like I said, like people that are day traders versus people that long-term invest. Like if I came to you now and I said, look, Debs, like I've got 5K and I'm working 9 to 5, so I don't have loads of time. What kind of direction would you give me? Let me pause the video for a quick word from our sponsors. Now, let me put you onto something that could seriously level up your property game. When I started investing, I didn't fully grasp the benefits of using a limited company structure. But here's the deal. Over 75% of new UK investment properties are now purchased through limited companies. Now, why? Because it's a more tax efficient way of purchasing. You can claim your mortgage interest reliefs, benefits from lower corporation tax rates, plus it sets you up nicely for scaling your property portfolio and passing on wealth to the next generation. Simply put, it can help you increase your margin. Now, setting up and managing a limited company might sound daunting, but that's where GetGround come in. They handle the entire process for you, from setting up your company in days to managing your accounts and tax returns and ensuring compliance all under one roof. They even help you find financing to help you fund your investments, your own dedicated consultant, and a completely digital dashboard to track and manage the performance of your investments. But because I'm serious about giving back, I've got a great offer for you. GetGround is offering a free investment consultation plus 3 months of free accounting and tax services when you sign up through my link. Now, this is a huge opportunity to get started on the right foot. So if you're serious about building or optimizing your portfolio, then check out the link in the description. Fill out the form for a free consultation and claim your 3 months of free services. Don't miss out on this. You can even transfer existing buy-to-let companies over to GetGround and still take advantage of the amazing offer. Now back to the video.
I'm a big fan of the stock markets, but I'm also a big fan of crypto as well.
We're gonna listen.
Yeah.
No, we're gonna speak about crypto because I'll be honest with you. I want to say it because my mum watches this. She tell me off, but I lost a lot of money in crypto.
Yeah,
and I've got quite a few wallets, but one of them I was saying, what's a good wallet? I need to find.
You see the money you lost?
Yeah,
that number is a course.
Yeah,
the market gave you a course in crypto and it charged you
it did
an arm and a leg.
I didn't listen to the course. I ran away. I ran away from the course.
No, but that is the course in the sense that when you invest and you do so from a place of not really understanding what you're doing, you see, whatever you lose, that is the course that the market charges. Yeah?
Okay.
That's fair. What I'm saying.
Yeah, that's fair. I just don't think I was a good student then. I don't think I learned my lessons from that
The market
course.
doesn't teach you.
Oh, it doesn't teach you.
It doesn't teach you the lesson. It takes your money, and that's the lesson.
Because even, all right, cool. I think I got a few, but this one, I was like, this one, I haven't touched this wallet in like 4 years.
What is it on? What wallet?
Binance.
Okay, yeah.
Is that all right? Yeah. Is that okay?
That was what I was using all through lockdown as my core.
Times, yeah.
And then the UK came in and made it impossible to deposit into there, and they just made life difficult for you.
Binance, and I think it's Trust Wallet. Is that all?
Binance? So Binance is an exchange.
Okay.
So that's like an Amazon.
Do you know what? Yeah. Let's break this down for a lot of people that just are not familiar with like. So we'll do a little bit on crypto and then go back to the stock.
Yeah.
So give us examples of what exchanges are, and then just some examples of exchanges people can use.
Okay, so an exchange is where you can go and buy crypto.
So I can buy Amazon. Crypto in Binance.
Yes.
I just don't know how to. I've been trying to move some crypto. Do you know, actually, I've got I think I think you told me actually. But have a look at I think I've got 2K here. Like I know I've got some stuff that's invested, but I think there's 2K in USDT that I was told. That's not good, is it, to have that just sitting there?
Um, it's all right.
It's all right, but it's just like having money in the bank
Yeah, in dollars.
in dollars.
USDT is pretty much just dollars.
So what should we invest that in? We're gonna invest it live and direct, and then we're gonna come back to this podcast in a year's time.
Yeah.
Yeah, no, I'm gonna give
I
you
think you
full
should
autonomy.
own. I think everybody should own one Ethereum
Okay, I don't
at
know if do I
least.
have any Ethereum.
Um, let me see what you
I
have.
don't even know how to navigate.
Yeah, so if you click on assets, yeah,
Yeah.
it will tell you what you hold.
Oh, what I can't really hold.
Yeah. You have. Yeah, you have about one Ethereum.
Oh, that's what I'm
Was that
saying.
the one
No,
that's when I said in?
no,
Did
I
I
don't
tell
know.
you to?
No, I'm just.
No.
I
Okay.
don't
Yeah.
know what's going on. I don't
Yeah.
even
So
know
you
what's in
got.
there.
I'll
What
show
else
you.
have I
I'll
got?
show you off air. Like
What I've got here. No, I don't mind. You can tell me.
So you got Ethereum.
Yeah,
You got USDT.
yeah.
You've got
I know.
Zcash.
I know. I've got. What's the one? Buy. Oh, my friend used to say it to
VeChain.
me all the time. Buy.
VeChain.
I think no, it's the one I've got the most of.
Yeah, that's. It's looking like that's. Oh yeah, where is it?
XRP.
XRP.
But I say all this to say, like, looking at the currencies, and obviously, when you see everybody, you know, friends are making 10,000, 100,000 in like a couple of days, and I said, no, I'm missing out. But I think it really is the understanding, because if you invest without information, your risk skyrockets, regardless of if somebody gives you some good advice. You
Yeah.
need to really understand what you're doing for yourself as well.
Yeah. So no, it's an interesting portfolio there. So I think the key thing people need to understand, because I was listening to a podcast and someone said they invest in, I think Julia the new girl. She was like, "Oh, crypto's gambling, it's risky." I was like, no, it's not. If you don't understand crypto, what happens is your bias will make you listen to all the bad stories. But those bad stories are all people who've done it the wrong way. Right? That's why they're telling those bad stories. Whereas if you look at the price of crypto, right now, it's about 100, it's over 100K. And it's been over 100K for 30 days.
For Bitcoin.
Right.
Yeah.
4 years ago, it was at 60K. 4 years before that, yes, there's volatility in between those 4 years. But someone that just bought Bitcoin and held it till today is up. Someone that bought Bitcoin in the buying phase of the cycle's 4 years, and sold it in the selling phase of the cycle, which we're approaching soon, end of the year, start of next year, and just did that every 4 years. Since the start of Bitcoin, or where people were really buying it, let's say 2012 buy, 2017 sell, 2023, 2019, 2015, 2011, these are the buy years. Period. The years where there's a buying phase, and 2027 is the next one. That's 5 transactions to buy, 5 transactions to sell. So you've done 10 transactions in 13 years, 14 years. Is that a lot? Is that?
No, but I guess it's in hindsight, it's easier to say when the right buying years / selling years and getting it in the right places.
Yeah.
I think the thing for me, I guess, like,
No, let me
go
drop that understanding, because I think once people understand that there's a method to the madness, they will see that, okay, there is a logic to it. People aren't just randomly putting, well, a lot of people are putting random money in, but what's really happening is, if you understand how Bitcoin is created and what the people in Bitcoin are doing. For example, let's say you got a reward of like a Rolex every time you solved some equation. 4 Rolexes actually. And I say in 4 years' time, for solving a more complex version of that equation, the levels get harder every time you solve it.
Yeah.
You only get 2. And then 4 years later, you only get 1. And then 4 years later, you only get half. There's a similar concept in Bitcoin. So there's something called Bitcoin miners. And what they do, and it takes a lot of electricity and hard drives and all this kind of stuff, is they create lines of code or algorithms to solve the Bitcoin equation. And each time it solves one, they get rewarded with, I think now it's 6 Bitcoins. And the next 4 years, it will be 3 Bitcoins.
Yeah.
So these events are called halving events. So there is a date where that happens. And if you know what that date is, so I think the last one was April 2024.
Yeah.
The one before that, I think, was May 2020. So we know what the dates are. All we then need to do is see, how does price behave before that date? And how does price behave after that date? And is there a consistent cycle, a pattern? And what you do when you actually look at the charts, I mean, I can pull it up for you now.
No, it's not.
Yeah.
Do you know, like, but you see, for somebody
Now that you see the
not in
logic
it-
though, but once you see, a lot of people haven't even understood that logic that I'll just explain now. What they've done is they've heard Bitcoin is something that can make you money, and they've just gone bang,
No,
out of alignment.
so I understand that side of things, yeah.
Yeah.
No, I don't, because that whole maths element of how, like, you know, maths and problem solving can make you money. But I guess if I was to relate it to something, I would just relate it to scarcity.
Yeah.
So the less available something is, generally, the more it costs, so long as you can attribute a value to it. So, i.e., for example, finding a diamond in the ground, realistically, a diamond has no purpose. But
Yes.
because it's scarce, I mean, they're strong, like, but that's not why they're valuable. Because it's scarce, it has a much higher value, because we put it in jewelry, found a purpose for it. Bitcoin, I guess, is similar in that you can use it for transactions. You've created a purpose, but there's a scarcity element. But the whole idea of like the scarcity, because there's this halving, the maths, I think is very akin to like the scarcity element of diamonds. They're owned by a limited number of companies, and the supply of them is effectively controlled to keep the price, you know, at a certain point. But it's like, I guess it's the same argument then, really.
Arguably gold as well.
Yeah, to a degree as well.
People still buy gold because they understand gold, and gold has been around through history. A digital equivalent, or something that looks like a digital equivalent of gold, I can understand how it can be a little bit difficult to put in the same category. But investing in crypto today is very different to 4 years ago or 8 years ago, when there wasn't that much adoption. Now there's no excuse, because you can see that companies are adopting it. PayPal has crypto. Like, the adoption levels is different now. I could understand someone not understanding crypto 8 years ago, but now I struggle a bit more, because...
But do you not think like the company adoption, so for example, the BlackRocks, the Goldmans, the etc.,
the government's adding it to their treasury,
actually is the reason that crypto, as a like crypto and tokenization, is almost doomed from creating the products that they actually want to create? Because say, for example, like, I don't know, there's a great tokenization of something, maybe in the music space, like to be able to allow you to own different parts of music, to help a streamer or content creator build something. And it's a really good idea with a good premise, right? And then you get early adopters that invest, like it could be a Goldman, it could be a BlackRock, for example, and they invest a certain amount of money in this product, but then on the basis that it's a good product. But actually, because they're like an asset firm that's trading based on returns, they then be like, look, they're trading on behalf of their clients. They then hit a 400% return. They're like, well, we can exit now. We've done our job. We do our trades. We get out. And then now, because of that whole conversation around supply and demand, there's actually an exit now. The product was actually really good, but now consumer confidence in the product drops because these big external firms are just focusing on the money rather than the idea behind the tokenization or behind the asset.
Yeah, the thing is, the same can be said about stocks. So there are some stocks in the stock market you can say exactly the same thing about, but the stock market still exists and there's still stocks investors,
Yeah.
right? Now, maybe a good time to draw that parallel in stocks is that there are two ways to invest in the stock market. There's actively picking individual stocks, just like you can actively pick individual cryptos. But there's also what I call buying the smoothie, right? You know, with a smoothie, you look at the back of it, there's got different percentages in it.
Yeah.
You don't have to buy the fruits individually. Buy the smoothie maker, blend it. You can. That's what stock picking is. But you can actually, if you haven't got time, you can actually go out, buy the smoothie, and you will average about 10% a year. And when you do the comparison test again, you'll realize that in a tax-free manner, £100 a month for 25 years into an index fund like the S&P 500 is going to average you 10% a year. So that £100 a month for 25 years will actually grow to 125k tax-free. So now imagine you do that for your child when they're born. You know that you can gift your child 125k tax-free when they're 25. How many 25-year-olds today can say that there's 125k just waiting for them?
Yeah, no,
right?
for sure.
So, and you can do that without needing to spend a lot of time every month. You don't need to keep checking your portfolio. This is hands-free. This is passive. This is 0 minutes a month when it's set up, right? And you can still invest in property.
Yeah.
And you can still invest in crypto. But you know that, do you know what I can get out of the stock market from a place of limited understanding is that for the past 100 years, this specific smoothie, S&P 500, has averaged 10% a year. You up the amount to like 850, your child becomes a tax-free millionaire. And you, depending on who you do it for.
How many years was that?
25 years.
25 years.
A lot of people, and if you're picking individual stocks as well, because back to your question on what I'd, do with 5K, I'd say 3K is for picking individual stocks, and 2K, I'd set up £200 a month rather than putting that whole 2K in one chunk. But after the Donald Trump thing, that's when you'd put like a lump sum of 2K and just let it ride and then set up a direct debit after. And then with the other 3K, you don't even need to have many stocks. You can have, I don't know, probably I don't know if you remember the message I put in the WhatsApp chat. There was an alert after Donald Trump, 2 stocks, Nvidia and Coinbase. Both of them are up nearly 70% since. And those are high conviction alerts for the long term. But 2 months later, you're 70% up because price matters.
Yeah.
And a lot of people think you can't time the markets. And I know that you can. I've been around algos that have been timing the markets for 15 years. I've been around professionals whose job it is to time the markets, and that's what they get paid for, right? So if I can incorporate aspects of what I know about how to time the markets into a long-term investing strategy, that's when you get scenarios like that. And that's why with Chest, I can say there's 2 stocks that are big, that are safe, that are in good industries, that thanks to Donald Trump's madness have given us long-term buy opportunities where Christmas can come early.
And I do think, look, we talk about it in the property space. Like, everybody always looks at doom and gloom, like Donald Trump's being crazy, the world's going to end. But actually, those that are early adopters, those that, see the potential, see the opportunities in the threats, are the ones that often make money. So it's very much a case of those, I guess, calculated risks where, I'm sure you'll probably know this more than myself in your space because the market moves a lot faster.
Yeah.
But market volatility and change generally equal opportunities and profits for those that are willing to be able to see where the market will potentially move. So like if we take, for example, like during 2020 with lockdown, and also that coupled with the like geopolitical instability in Ukraine and Russia, like the amount of people, and also things that were going on in India and Pakistan, the amount of millionaires exiting those countries, and the fact that the UAE had very loose COVID laws meant the amount of money that went into that country at that time, the property prices over there, like, you know, in some areas were going up 50% in 6 months. But I guess if you have a background of being able to see, okay, you know what, let me just not look at my kind of very tunnel vision space and look at the world as a bigger picture and broader market spectrum, you can see that, okay, like you said, this is happening over there. Because this is happening, these people are moving, their money's cycling over here, which means X can happen. So it's very similar, I guess, but I just think the property market, because it's based more on consumer confidence than market confidence, the trickle down of those things happening, we don't see it for another 6 to 12 months because it's just not as, it's a lot more illiquid.
Yeah.
You can pick up a stock today and trade it within minutes.
Yeah.
Whereas property, even people that say they trade property, there's still time lags because of land registry stuff, because of all sorts of different things on actually being able to trade property.
All right. How about buying property in your pension via the stock market?
So talk to us about how is that done?
So in the stock market, you see the company that owns Westfield and rents out the shops.
Yeah.
UNBLF. If you Google it, you'll see that company has a share price. So that company is listed on the stock market, which means that you can buy a share of that company in your pension or in your stocks and shares ISA. And these companies have to pay out, I think, is it 90%, 70 to 90% of their rent they need to give back to shareholders in the management, in the holding company. So what that means is you can earn rent on these properties, click of a button, right? So an example is one called IIPR. So they own cannabis warehouses in Canada where it's legal. And I remember the alert price on my watch list was at 70. And this stock price went all the way up to like 280. The sell was 250. So you have more than tripled your money on price appreciation. So that's like buying a house and it triples in value.
So just for those of us like myself that are not familiar, talk us about what is the watch list price, what is the sell price, what are these things like? Are they stop gaps that you put in to protect yourself of when to buy and to sell? Are they alerts? What do they mean?
So investing is a team sport, right? I think if you try and learn yourself, self-taught learners, and you're just in your room, you miss out. And I'm a beneficiary of this myself. So the group I created for everyone, I started benefiting from it myself. So someone would just say, "Oh, guys, do you know you can invest in this property REIT?" So REIT is real estate investment trusts. So what I realized is, to make that process more efficient, let me create a centralized watch list on Google Sheets. So everyone who's got the link can access that watch list and can see anyone can add anything to the list. So now we're all singing from the same hymn sheet. So what I then did is I applied my experience to create what I call long-term buy prices. So let's say when Tesla hit $400 a share, and by the way, you can buy fractional shares. You don't need $400 to invest in Tesla. You can buy like a bit. You can buy £5 worth of Tesla. So I would set that alert price at $200, even though the current price is $400. right? Because I've done some checks, I've looked at the charts, I've everything I know,
You're
basically.
saying if it hit 200,
If it
you
hits
would then say,
200,
look, whatever's
buy.
going on in your life right now, buy is at that point, you haven't got to do more research, more
No,
whatever. I just
no,
know
I've
that
done the due
I've
diligence.
hit
I've
that
done the
number.
financial health checks. I know who the CEO is. I've done my due diligence on Elon Musk. We've even done that as a group. We've discussed it multiple times, due diligence on multiple stocks, but it may never hit that $200. And that's okay. It just means I'll never ever buy Tesla in my portfolio. So my portfolio only consists of, so the watches has like 1,000 stocks, ETFs, REITs, and some, I think 10 to 12 cryptos and alert prices that are unrealistic. Like people, when I put, Debs, what about this stock? It's done really badly. It's down 30%. And I'll say, well, my alert price is down there. And then they look at me, they're like, but it doesn't look like it's never hit there before. That's the price. That's fantastic. That I can give to someone who's new and say, that is your starting point for investing in this company. Margin of safety is big enough for me to be able to vouch for it at that price. Because you can lose money on a great company, but you can also make money on a bad company going through struggles. So a typical example is Peloton. Peloton went from about 180 all the way down to my alert price. Do you want to guess what my alert price was?
What, it was at 180? I don't know, 60? Lower? Higher? Lower. I don't really like.
Yeah, I'm going to tell you.
Yeah, got it.
It's like 3.
But why
But
would
I said, you know what? If it gets to 10, some people can. Because the strategy isn't just alert price, go in. The strategy is, this is the alert price of the £1,000 you want to invest in this stock. You can only invest 500 of that.
Yeah.
And you'll put the other 500 if it drops a further X percent, 50, 70, 80. And if you do that, then your average price. So if you buy at 10 and you buy some more at, say, 1, £500, £500, your average price is 1.8. Even so, it only needs to get to 2 for you to be in profit. If it gets to 4, you've made 100%. Right. So these price can behave like an elastic band. The lower price gets to 0, the more it becomes less about the company and more like physics. It's literally eventually stops behaving like a stock and starts behaving like an elastic band that's been stretched. So that even that movement from 1 to 4 can happen in a week.
Yeah.
So I've learned this and I've seen this in action for specific types of companies, and it's all due to psychology. So the explanation is, at those prices down there, people who've sold the stock and looking to profit are buying. People who are speculative, just taking a punt at this cheap price, are also buying.
Yeah.
People who are in the stock already and are buying more to average their price are also buying. So you've got 3 types of strong buyers at the same time. And that's what causes the momentum to shift. And over time, you know, like football, eventually, whether you're pro or even whether you're just playing five-a-side, you don't look at the ball and like pass it. It becomes muscle memory. You just know how to pass a football. Likewise, me looking at price for the past 15, 16 years, I've got a very good feel of the market. So when I'm setting these alert prices, there's a combination of that, combination of chart work, combination of my assessment of the business, everything. And what I've seen is over time, I've honed this strategy. I've designed it in a way that's easy to teach. So someone will come and do my course, and instead of learning how to be a mechanic, they learn how to drive. They learn something they can use right now and apply, and then do that within a group as well, where I'm there for them to ask, tell me before buying, tell me before selling. So having a watch list that everyone in the group is looking at with these alert prices that are long term, as well as the equals, which teaches you the strategy you can use on those alert prices, gives you a overall experience where you can actually start investing in the stock market now, rather than walking the walk I've walked, which was kind of failing my way to success. It took me 3 years before my portfolio actually yielded an overall profit. And I've got clients who work in makeup, who work in fashion, who've doubled their portfolios in their first year, who've doubled it in the first 6 months, right? And that for me is my achievement. Like, I feel like you didn't have to go through what I went through. You're learning from my mistakes and the collective mistakes of my mentors and everyone else in the group that was learning, failing their way to learn. But you can access that now by learning this. In the past, strategies were gatekept. Imagine like in property, lease options.
Yeah.
It was only a while before people started writing books and courses on it. It was like, if you know thing. Likewise, in the stock market, historically, if you had a strategy that was working, you don't share it. Because there's this paranoia that if everyone is using your strategy, then it loses itself, which isn't correct.
I think there's a lot of parodies between investing in property and investing, in stocks, particularly investing in like S&P funds and, like you said, the smoothie, the blended funds that have seen and proved the test of time.
Yeah.
If people want to connect with you more, if they want to find out more, and actually if they want to find out if off camera when we do our trades that we're going to do today, if we find out if they're successful, how can people connect with you? How can they get in touch with you?
Instagram, coachdebs.spa is my personal, and I think now I just do loads of collab posts between the two, but Stock Pickers Academy is where I try and post educational content, but that's just, you'll learn something, like all S&P 500 stuff. I don't believe in charging for that, right? How to set up a smoothie and earn your average 10%, that information is on ChatGPT. You can literally ask it that, right? Whereas having a strategy to pick individual stocks, that's what I charge for. So you pay to learn the strategy, and then you pay to be in the community, a monthly fee.
Well, we appreciate having you on today. I know I've definitely learned a lot. I'm going to find out what I'm going to invest in. I'm hoping it's going to be good. Going to invest 2K in something. So if you haven't already, make sure you subscribe so you can find out how my investments go. But more importantly, each and every week, we're going to have another amazing guest that's going to teach you something about investing, about property, or about business, or just about mindset to make you a better version of yourself. Peace.
Peace. Thanks for having me on, man.
Thank you, brother.
Good discussion.